Welcome back to the deep dive. We're here again to plunge into something complex, break it down, and pull out what really matters for you. Today, we're navigating a corner of the financial world that can feel incredibly intricate, but it holds immense power for your long-term planning and for supporting the people you care about. We're talking about the art of gifting, specifically how to transfer wealth smartly, making sure it gets where you want it to go without unnecessarily enriching Uncle Sam. And our guide for this journey, it's the source itself, the official IRS Form 709, the United States Gift and Generation Skipping Transfer Tax Return. Plus, of course, its very detailed instructions.
That's right. And while, yes, IRS forms and instructions can look like a dense forest of regulations at first glance, our mission today is really to cut through that complexity. We want to distill the most important nuggets of knowledge, help you demystify the federal gift tax, and maybe more importantly, show you how you can strategically leverage these rules, use them to your advantage for future wealth transfer. Our focus? It's going to be squarely on the practical tax-saving methods, the opportunities that are actually embedded right there in the IRS guidelines. So yeah, let's dive in.
Okay, great. So to really understand this landscape, we need to start at the beginning. What is federal gift tax fundamentally? And why does Form 709 even exist? I think a lot of people might assume, if they give a small gift, it's no big deal. They don't have to worry. So what's the real purpose here?
That's the critical starting point. At its core, the federal gift tax is a tax on transferring property from one person to another without getting full value, or what they call full consideration, back in return. You can think of it partly as, well, a way to prevent people from just giving away all their assets during life to sidestep estate taxes when they pass away. Form 709 is the IRS's official tool for tracking these transfers. It's mainly for reporting gifts subject to the gift tax, and also, as we'll get into, certain generation skipping transfer taxes, or GST taxes. It's how you calculate any tax due. But it's more than just reporting. It's also where you formally allocate your lifetime GST exemption. That's a really powerful tax-saving tool we'll definitely explore later.
Okay, so it's not just about giving cash then. What exactly does the IRS count as a gift, as property count?
Oh, absolutely. And it's crucial to grasp how broad this is. The gift tax applies to transfers of pretty much any kind of property: real property, personal property, tangible things like a classic car, art, a vacation house, or intangible asset stocks, bonds, even intellectual property rights. These transfers can be direct, person to person, or indirect, maybe through a trust. And here's something that often surprises people. It even applies to sales or exchanges that aren't like normal business deals, where what you receive is way less than the value of what you gave up.
Can you give an example of that? A sale for less than full value? That sounds like a potential trap.
Sure. Let's say you own, I don't know, a piece of land. Fair market value is $500,000. If you decide to sell that land to your adult child for, say, just $100,000, that $400,000 difference, the value you basically gave away, that's considered a gift for tax purposes. It's that gap between the fair market value and what you actually received that the IRS focuses on. Another really key distinction: gift tax is totally separate from income tax. Making a gift doesn't usually create taxable income for the person receiving it. And it typically doesn't give you, the donor, an income tax deduction either. It's got its own set of rules.
Okay, that clarifies the scope quite a bit. Now, about filing. Who actually needs to file this Form 709? Is it everyone who gives any gift? Or are there special?
That's a really important question. And yeah, it's where people can get tripped up. Generally speaking, if you're a U.S. citizen or resident, you have to file Form 709 if you gave gifts, adding up to more than $18,000 to any one person other than your spouse during the year 2024. That $18,000, that's the annual exclusion amount. It's a key tax saver we'll definitely dig into. It's the main threshold. However, there's a really crucial nuance here, a common pitfall. Even gifts under that $18,000 annual exclusion, they must be reported if they're considered future interests.
Right, you mentioned future interest earlier. Can you give us another really simple example just to nail down the difference between that and a present interest? Why does it matter so much for filing?
Absolutely. It's fundamental to gift tax planning. A future interest is basically a gift where the recipient's ability to possess, enjoy, or control the property is delayed. It's not immediate. Like if you put money into a trust for your grandchild, but they can't actually get any funds until they turn 25, or maybe only after you pass away, that's a future interest. Another example is giving someone what's called a remainder interest in a property. They'll own it fully someday, but someone else gets to live there or use it for their lifetime first. The key thing is that $18,000 annual exclusion, it only applies to gifts of present interest, where the recipient has immediate, unrestricted use or enjoyment. So even if that future interest gift is valued at, let's say, $5,000, it still technically requires filing Form 709. Why? Because it doesn't qualify for the annual exclusion. This is a huge point for smart gifting.
Yeah.
If you want that annual exclusion, make sure it's a present interest gift.
Understood. And what about gift splitting? You hinted that if I split gifts with my spouse, I always have to file no matter the amount.
Correct. That's another specific trigger that overrides the $18,000 threshold. If you and your spouse choose to split gifts, meaning you treat a gift made by one of you to a third party as if it were made half by each of you, then you both typically must file your own Form 709. Regardless of the gift amounts involved, it requires formal consent. And for folks in community property states, it's worth noting, if you gift community property, it's automatically treated as made one half by each spouse. So if a couple gifts, say a $100,000 community asset, it's like a $50,000 gift from each. If that $50 K share is over the annual exclusion, each spouse needs to file.
Okay, so there are definitely times you must file. Are there clear situations where you definitely don't need to file the don't worry about it list?
Yes, absolutely. And knowing this can save a lot of unnecessary paperwork. You generally don't need to file Form 709 for a given year if all these conditions are met. 1, you made no gifts during the year to your spouse that require filing. We'll talk about spousal gifts later, most don't. 2, you didn't give more than $18,000 to any single person, anyone done. And 3, every single gift you made was a present interest. If you meet all 3 of those, you're likely clear for that year. But if any one of them isn't true, you probably need to file.
What about gifts to charity? Does that change anything?
Good question. There's a specific exception there, too. If all the gifts you made during the entire year were fully deductible gifts to qualified charities, and importantly, you transferred your entire interest in the property, no strings attached, then you generally don't need to file. However, and this is a key, however, if you also made non-charitable gifts during that same year that do require you to file Form 709, then you have to include all your gifts on the return, including those charitable ones, even if they're fully deductible. You can't just pick and choose which reportable gifts to show if you've crossed the filing threshold. It becomes an all-or-nothing situation for that year.
Okay, that makes sense. It clarifies who might not need to file. Seems like a lot to keep track of, though. What about the timing? When is Form 709 actually due? And can you get an extension?
Right, timing is key. Form 709 is filed on a calendar year basis. You report all your reportable gifts for the entire year, January 1st to December 31st, on one single Form 709. You can't file multiple 709s for the same year. The general due date, it's April 15th of the year, after the year the gift was made. So for gifts made anytime in 2024, the returns typically due April 15, 2025. And if April 15th happens to be a weekend or legal holiday, the deadline automatically shifts to the next business day.
What if April 15th is coming up fast and you're just not ready? Can you get an extension like you can for income taxes?
Yes. Definitely. Extensions are available, and it's pretty common. If you get an extension to file your federal income tax return, say, by using Form 4868 that automatically extends the time to file your Form 709 as well, you don't need to file a separate request for the gift tax return in that case. If you don't need an income tax extension, but you do need one for Form 709, you can file a specific form, Form 8892. That grants an automatic 6-month extension, usually pushing the deadline to October 15th. But, and this is a critical point that catches people out, an extension of time to file the return does not extend the time to pay any gift or GST tax that might be due. If you owe tax, that payment is still due by the original April 15th deadline. If you pay late, interest and penalties can start piling up even if you got the filing extension.
Good heads up there. Pay on time even if you file late. What if the donor passes away before filing?
In that situation, the responsibility falls to the executor or the personal representative of the donor's estate. They have to file the final Form 709. It becomes part of wrapping up the deceased person's final tax affairs. And one last point on timing and finality. For the IRS's statute of limitations clock to start ticking on a gift, meaning the time they have to challenge its value or treatment is limited, the gift has to be adequately disclosed on Form 709. This isn't just about filing the form. It means providing a complete return with all the details, thorough description of the property, who received it, how you valued it, any consideration received. Without adequate disclosure, the IRS could potentially question that gift years, even decades later. Proper disclosure provides that certainty, that finality for your planning.
That's a lot of foundational ground covered. Okay, so we know what gift tax is, who needs to file. Now let's get to the really interesting part, the strategies. The IRS rulebook itself actually provides ways to, reduce or even eliminate gift tax. These sound like the tax-saving methods you mentioned. Where do we start with these cheat codes for smart gifting?
Exactly. And the first, probably the most widely used and powerful tool for consistent tax-free giving is the annual gift exclusion. This should be your go-to strategy.
Yeah.
The basic rule. The first $18,000, that's the amount for gifts made in 2024, of gifts of present interest given to each individual done, is completely excluded from gift tax. The key insight here, consistency. You can give $18,000 to as many people as you want, every single year, tax-free. And, crucially, if these are your only gifts and they meet the other conditions we discussed, you don't even need to report them on Form 709. Over time, these annual gifts can add up to a significant amount of wealth transferred completely outside the gift and estate tax system. It's a foundational tax-saving method.
Wow. So if I have, say, 3 kids and 5 grandkids, I could give $18,000 to each of them every year. That's 8 people, totally tax-free and no reporting needed. That's substantial.
Precisely. That would be $18,000 times 8 individuals, which is what, $144,000 you could transfer tax-free each and every year. And yes, if you make a gift into a trust, generally each identifiable beneficiary of that trust is treated as a separate done for this annual exclusion. So that opens up planning opportunities with trusts too.
Is there anything special about gifts to a spouse?
Yes. Gifts to spouses have their own rules. For gifts to a spouse who is a U.S. citizen, there's generally an unlimited marital deduction, meaning you can give them any amount tax-free, and typically you don't even report it, assuming it's not a terminable interest, which we'll get to. However, for gifts to a spouse who is not a U.S. citizen, it's different. There is an annual exclusion, but it's much higher than the standard $18,000. For 2024, you can give up to $185,000 tax-free to your non-U.S. citizen spouse, provided the gift would otherwise qualify for the marital deduction if they were a citizen. The reason for this difference is basically to ensure that assets held by a non-citizen spouse might eventually be subject to U.S. estate tax, since the unlimited marital deduction doesn't apply in the same way. It keeps assets within the potential reach of the U.S. transfer tax system.
Okay. Now, you've stressed this present interest requirement a few times for the annual $18,000 exclusion. Can you hammer that home again, maybe with another example? It really sounds like a common way people could mess up.
It absolutely is a frequent point of confusion, and yeah, getting it wrong can trigger filing requirements you didn't expect. Remember, present interest means the recipient has the immediate unrestricted right to use, possess, or enjoy the property or the income from it. Right now, think simple. Cash in their bank account, handing over the keys and title to a car, giving them stock certificates they own outright. They can use it or benefit from it immediately. On the flip side, if you put money in a trust and the beneficiary can't get distributions or access the principal until, say, they hit age 30, or maybe until some other future event happens, that's typically a future interest. And even if the amount you put in is less than $18,000, you likely have to report it on Form 709 because it doesn't qualify for that annual exclusion. Now, there's a common technique used with trust to make contributions qualify as present interests using something called crummy powers. These give the beneficiary a short temporary window, like 30 days, to withdraw any contribution made to the trust, because they could take it out immediately, even if they don't. It satisfies the present interest rule for the annual exclusion. So yes, for smart gifting, especially involving trusts, understanding and ensuring present interest is absolutely vital if you want to use that $18,000 annual exclusion effectively.
Okay, the annual exclusion is clearly a major tool, but I've also heard there are certain payments or transfers that the IRS doesn't even consider gifts in the first place. Can you walk us through those? This sounds like another huge tax-saving opportunity.
You're right. These are true exclusions, not just deductions or the annual limit. They're incredibly powerful because they don't use up any of your annual exclusion or your lifetime exemption amount. They just don't count as gifts, period. The IRS specifically lists a few types of transfers that fall outside the definition of a gift for Form 709 purposes. They don't need to be reported at all. First, transfers made for the use of political organizations, Section 527 organizations, so contributions to political campaigns, parties, committees, not gifts for gift tax. Second, gifts to certain specific types of tax-exempt organizations beyond the usual charities. We're talking certain civic leagues, labor, agricultural, horticultural organizations, or business leagues, sections 501c4, 5, 6, less common for personal giving, but they're excluded. Third, and this is a really big one for many families, payments that qualify for the educational exclusion. This is a fantastic way to pay for someone's education with zero gift tax consequences. For this exclusion to apply, the payment must be made directly to the qualifying educational organization. That could be a university, a private high school, a trade school, even a foreign school. And critically, this is key. It must be for tuition only.
Tuition only, so not for room and board or books.
Correct. Payments for books, supplies, dorm fees, room and board, other living expenses.
Yeah.
Those don't qualify for this specific educational exclusion. If you pay those, they would be considered gifts to the student, and you potentially use your annual exclusion for those amounts. but the tuition payment itself made directly to the school, not a gift.
So wait, if I want to pay my grandchild's college tuition, I just send the check directly to the university's bursar's office, and it's totally gift tax free, no matter how much the tuition is. And it doesn't matter that it's my grandchild.
Exactly. That's the power of it. And a crucial point here. This educational exclusion applies without regard to the relationship between you and the done. You can pay anyone's tuition directly. Your child, grandchild, niece, nephew, a friend's kid, even a complete stranger. Pay the school directly for tuition, and it is not a gift for tax purposes. It leaves your $18,000 annual exclusion untouched for other gifts you might want to make to that person. But there's an important caveat we need to mention again. Contributions to qualified tuition programs or 529 plans, they do not qualify for this direct payment educational exclusion. 529s have their own special, very beneficial rules we'll cover separately.
Okay, that direct tuition payment is a massive tax saver. What's the next big one?
The fourth major exclusion is the medical exclusion. It works very similarly to the educational one. It lets you pay for medical care for someone else without it being treated as a gift. Again, the key requirement. The payment must be made directly to the person or institution providing the medical care. That means paying the hospital, the doctor's office, the dentist, the pharmacy directly. And the payment has to be for medical care, as defined by the IRS under Section 213. This generally covers expenses for diagnosis, cure, mitigation, treatment, or prevention of disease. It also includes costs affecting body structure or function, transportation essential for care, and importantly, medical insurance premiums.
So just like tuition, I could pay, say, my elderly parents' hospital bill or their health insurance premium directly, and it's not a gift, regardless of the amount.
Absolutely. And just like the educational exclusion, this medical exclusion also applies without regard to the relationship between you and the done. End quote. You could pay your parents' nursing home bill directly to the facility. You could pay a friend's significant surgery cost directly to the hospital. You could pay a cousin's health insurance premium directly to the insurance company. None of those payments would be considered gifts for tax purposes. It's an incredibly practical and compassionate way to provide substantial financial support for healthcare needs without eating into your annual or lifetime gift tax exclusions. A huge tax-saving method, especially for unexpected or large medical costs.
Are there any catches or limitations with the medical exclusion, like the 529 plan thing for education?
Yes, there is one important caveat here. The medical exclusion does not apply to any amounts you pay for medical care if those amounts are later reimbursed by the recipient's insurance. So if the person you're helping has insurance that covers the bill or part of it, and they get reimbursed, then your payment, to the extent of that reimbursement, is not eligible for the medical exclusion. In that case, you'd be treated as having made a gift to the recipient of the reimbursed amount. For example, you pay a $10,000 hospital bill for your friend directly. Later, their insurance reimburses them $8,000 for that bill. That $8,000 portion of your payment is now considered a gift to your friend, which would then potentially use up part of your $18,000 annual exclusion for them. So you need to be mindful of insurance coverage.
Okay, that makes sense. Pay directly and make sure it's not covering something insurance already paid for. What was the last exclusion you mentioned? Something about disclaimers.
Right. Qualified disclaimers. This is a bit more specialized but can be very useful. A disclaimer is basically when the intended recipient of a gift formally refuses to accept it. If someone makes a qualified disclaimer of an interest in property, the tax law treats it as if that property never passed to them. This means the person disclaiming isn't considered to have made a gift themselves to whoever ends up receiving the property as a result of their refusal. This can be a powerful tool in estate planning, maybe if an inheritance comes at an awkward time or would push someone into a higher tax bracket or disrupt existing plans.
So someone can just say no thanks to a gift or inheritance, and it just bypasses them for tax purposes. What makes it qualified? Seems like there'd be rules.
Oh, absolutely. There are strict rules. For a disclaimer to be qualified, it generally must be 1. In writing, 2. Received by the donor or their representative or the holder of legal title within 9 months of the transfer creating the interest, or 9 months after the disclaimant turns 21. 3. The person disclaiming must not have accepted the interest or any of its benefits before making the disclaimer. You can't use it, then refuse it. And 4, as a result of the refusal, the interest must pass without any direction from the person disclaiming to someone else, usually whoever would have received it if the disclaimant had predeceased the donor, or to the spouse of a decedent. If all those conditions are met, it's a valid way to redirect assets without triggering an additional layer of gift tax. It's a precise tool, but very effective when needed.
Wow. Okay, so summing up this section on exclusions. Direct payments for tuition and medical care are huge tax savers because they aren't even gifts. And the annual exclusion of $18,000 per person per year is the bedrock of ongoing tax-free gifting. That's incredibly valuable information.
Absolutely.
Yeah.
These exclusions are your first line of defense, your primary tax-saving methods when it comes to gifting. Understanding and using them strategically can make a massive difference.
Now, this brings up an important question, especially thinking about that annual exclusion. How can married couples work together? Can they combine forces somehow to give even more tax-free? Gift splitting sounds like it might be the answer.
Gift splitting is exactly that. It's a fantastic example of spousal teamwork and a really powerful tax-saving strategy for married couples. The concept is simple. It lets a married couple treat gifts made by either one of them to a third party, so not to each other, as if those gifts were made one-half by each spouse. The immediate impact. It effectively doubles the annual exclusion per recipient. Instead of just one spouse giving $18,000 tax-free to, say, a child, the couple, by electing gift splitting, can give a combined $36,000 to that child in 2024. All tax-free, all without using any lifetime exemption.
So wait, a couple wants to help their 2 kids and maybe 4 grandkids. Using gift splitting, they could give $36,000 to each of those 6 people every single year. That's a huge boost to their gifting capacity.
It absolutely is. In your example, $36,000 times 6 individuals. That's $216,000 per year, completely free of gift tax, assuming they're all present interest gifts. Think about that over, say, 10 years. That's over $2 million transferred, completely outside the gift and estate tax system, just by maximizing the annual exclusion through gift splitting. It's an incredibly effective strategy, especially for larger families or those wanting to accelerate their wealth transfer plans.
That's a massive tax saving. What are the hoops you have to jump through? What are the requirements for a couple to do this? And how do they actually make the election?
There are a few key requirements. First, obviously, you have to be legally married to each other at the time the gift is made. Second, if you get divorced or one spouse dies later in the year after the gift was made, the spouse who made the gift cannot have remarried during the remainder of that calendar year for splitting to apply to that earlier gift. Third, both spouses must be U.S. citizens or residents at the time of the gift. And fourth, the donor spouse cannot give the other spouse a general power of appointment over the gifted property. Basically, you can't give your spouse complete control to decide who ultimately gets the property you're splitting.
Okay, seems straightforward enough. How does the paperwork work? Do they file together?
That's an important detail. Married couples cannot file a joint gift tax return. Each spouse has to file their own separate Form 709 if they're required to file. To elect gift splitting, both spouses must signify their consent. Usually, the spouse who did make the actual gift signs a consent section on the Form 709, filed by the spouse who did make the gift. If both spouses make gifts that are being split, or if the total split gifts require both to file anyway, then both file their own 709s and indicate consent on each. A crucial consequence to understand. If you elect gift splitting for any gift during a calendar year, then all gifts made by either spouse to third parties during that year, while you were married, must be split. You can't pick and choose which ones to split. And here's a big one: liability. If you consent to gift splitting, you and your spouse become jointly and severally liable for the entire gift tax liability of both spouses for that year. That means the IRS could come after either one of you for the full amount of tax due on all split gifts made that year, even if your spouse was the one who actually made the gift that generated the tax. It requires trust and shared understanding.
Okay, so joint liability is something to be aware of. Are there situations where they split gifts, but maybe only one person needs to file a Form 709?
Yes, the instructions mention a couple of exceptions that can simplify filing in specific cases, even with gift splitting. For instance, if only one spouse actually makes gifts during the year, and the total value of those gifts to each individual third party done doesn't exceed $36,000, the doubled annual exclusion, and all the gifts are present interest, then only the spouse who actually made the gifts needs to file a Form 709. The other spouse just signs the consent on that return. There's a similar exception if one spouse makes gifts between $18K and $36K, and the other spouse only makes gifts of $18K or less to different dunnies, all present interest. Again, only the spouse making the larger gifts might need to file. But for any gifts over these amounts or involving future interests, or if both spouses make significant gifts, then yes, both will likely need to file their own Form 709s.
Got it. Gift splitting. A powerful tool for couples, doubling that annual exclusion. Let's shift to another major spousal strategy, especially relevant for larger estates: portability. What's the deal with portability of the deceased spousal unused exclusion, or DSUE?
Right, portability is a really significant development in estate planning. The core idea is to allow a surviving spouse to basically inherit and use the unused portion of their deceased spouse's federal estate and gift tax exclusion amount. This unused amount, the DSUE, gets added to the surviving spouse's own basic exclusion amount. For 2024, the basic exclusion is substantial, $13,610,000 per person. So imagine a spouse passes away having used only, say, $3 million of their exclusion. That leaves over $10 million unused. Portability allows that unused $10+ million DSUE amount to be transferred to the surviving spouse. This can dramatically increase the survivor's total available exclusion, letting them make much larger tax-free gifts during their lifetime or pass significantly more wealth tax-free at their own death. It's a major tax-saving mechanism for wealthier couples.
That sounds like a huge benefit, potentially doubling the amount a couple can shield from estate and gift tax. What's the catch? Is it automatic? Or do you need to do something specific?
It is absolutely not automatic, and this is where proactive planning is critical. The key condition: the executor of the first spouse's estate must make the portability election on a timely filed and complete U.S. estate tax return, Form 706. Even if no estate tax is actually due because of deductions or the exclusion amount, the Form 706 generally still needs to be filed just to make that portability election. If the election isn't made, or isn't made properly and on time, that DSUE amount is simply lost forever. This makes proper estate planning and communication between spouses, especially those with significant assets, absolutely vital. It's also worth noting that when a surviving spouse uses the DSUE amount for a gift, the IRS can look back at the deceased spouse's estate tax return to verify the DSUE amount claimed. They generally can't assess more tax on the first spouse's estate after the statute of limitations runs, but they can adjust the amount of DSUE available to the surviving spouse if they find it was calculated incorrectly.
How does the DSUE amount interact with the surviving spouse's own exclusion?
Good question. The rule is that the DSUE amount from the deceased spouse is applied first, before the surviving spouse uses any of their own basic exclusion amount. Think of it like you have two buckets of exclusion: the DSUE bucket and your own bucket. You have to empty the DSUE bucket first before dipping into your own. This ensures the combined amounts are maximized effectively. Interestingly, a surviving spouse can potentially benefit from DSUE amounts from more than one predeceased spouse. But there's a critical limitation.
Oh, so if someone remarries and is widowed again, they could potentially stack DSUE amounts.
They can accumulate them in theory, but here's the catch. You can only apply the DSUE amount from your last deceased spouse to your taxable gifts. So let's say your first spouse died, elected portability, leaving you DSUE. Then you remarry, and your second spouse dies. Even if that second spouse had no DSUE or didn't elect portability, only their DSUE amount, which might be zero, is available for you to use for gifts made after their death. Any DSUE from the first spouse effectively gets overwritten by the status of the last deceased spouse. This is a really important planning point for blended families or those who remarry.
That's a crucial detail. Okay, sticking with spousal rules, you mentioned something earlier about historical inequalities and a restored exclusion amount. Can you explain that? Why is it important?
Yes. The restored exclusion amount is a specific procedure that arose directly from the Supreme Court's United States v. Windsor decision back in 2013. That decision struck down the Defense of Marriage Act, or DOMA. Before Windsor, same-sex married couples were not recognized for federal tax purposes. This meant they couldn't claim the unlimited marital deduction for gifts or bequests to their spouse. So if one same-sex spouse gifted assets to the other, that gift would use up part of their lifetime gift and estate tax exclusion, or even trigger gift tax, simply because their marriage wasn't federally recognized. Opposite-sex couples didn't face this issue.
So the restored exclusion amount is essentially a way to fix that past unfairness, put those couples back on equal footing tax-wise.
Precisely. It allows donors who made those taxable gifts to their same-sex spouse, gifts that reduce their exclusion amount solely because of DOMA, to recalculate their remaining exclusion and restore the amount that was used up due to that discriminatory treatment. The impact is significant. It increases their available exclusion for future gifts or for their estate, effectively putting them in the same position they would have been in had their marriage always been recognized. The mechanism involves a specific calculation based on the proportion of taxable gifts made to the same-sex spouse compared to total taxable gifts in those pre-Windsor years. This calculated amount is then added back to their available exclusion and accounted for on future Form 709s. It's an important corrective measure ensuring fairness.
That's a really vital correction. Now, let's pivot to another marital strategy, one that involves terminable interests. You mentioned the marital deduction in QTIP election. Sounds technical.
It is a bit technical, but very useful in certain estate planning situations, particularly for blended families, or when someone wants control over the ultimate destination of assets. As we said, the general rule for gifts between U.S. citizen spouses is the unlimited marital deduction, but that typically applies only to gifts of non-terminable interests.
Yeah.
That means gifts where the spouse receives full outright ownership doesn't end based on some event or time limit. Giving your spouse cash or your house outright, that's non-terminable.
Okay, so if I give my U.S. citizen spouse the house outright, it's tax-free, no reporting needed. Simple.
Correct. That's the unlimited marital deduction working simply. But things change with terminable interests. A terminable interest is one where your spouse's interest in the property could end or fail based on time passing or some event happening or not happening, and then someone else, like your kids, gets an interest in that same property. Think of putting assets in a trust where your spouse gets the income for their lifetime, but after they die, the principal goes to your children from a prior marriage. Your spouse's interest is terminable because it ends at their death. Generally, gifts of terminable interest do not qualify for the marital deduction.
Ah, so that's where QTIP comes in, qualified terminable interest property.
Yes, exactly. The QTIP election is a major exception to that rule. It allows you to elect to treat certain terminable interest property as qualifying for the marital deduction, even though it's terminal. The most common type of QTIP trust requires that your spouse is entitled to all the income from the property for their life, paid at least annually, and that no one, including the spouse, has the power to appoint any part of the property to anyone other than the spouse during the spouse's lifetime. You make the election simply by listing the QTIP property on Schedule A of Form 709 and claiming the marital deduction for it. The IRS actually presumes you've made the QTIP election for any property you list and deduct that meets the requirements. One critical detail: the QTIP election must be made on a timely filed Form 709. You can't make it on a late return.
Okay, so making the QTIP election turns a normally non-deductible gift into a deductible one. That saves tax now. Is there a downside? What's the trade-off?
You hit it exactly. It provides the marital deduction up front, deferring the tax. The trade-off is crucial for planning. The value of that QTIP property will be included in your spouse's gross estate when they die, under Section 2044. So while you avoid gift tax now, the property will eventually be subject to estate tax later in your spouse's estate, assuming their estate is large enough. It's tax deferral, not tax elimination. This is often used when someone wants to provide for their current spouse for life, but ensure the assets ultimately go to children from a previous relationship. It provides income security for the spouse while preserving the principal for other beneficiaries. There's also a specific rule about joint and survivor annuities where only the spouses can receive payments. QTIP treatment is automatic there, but the donor can elect out if they choose.
All right, we've covered the core exclusions and spousal strategies. Lots of powerful tax-saving methods there. Now let's explore some more specialized tools, maybe involving trusts or specific types of accounts, especially for longer-term planning or passing wealth across generations. Where should we look next?
A great place to start is with something many families use: qualified tuition programs, better known as 529 plans. As we mentioned, contributions to 529s don't get the direct payment educational exclusion, but they have their own special and, frankly, very powerful give tax rule: the 5-year spread election. This is a major planning technique.
The 5-year spread. How does that work exactly? It sounds like you can sort of front-load multiple years of gifting at once.
That's precisely it. It's a fantastic tax-saving tool. If you contribute more than the annual exclusion amount, $18,000 in 2024, to a specific person's 529 plan in a single year, you could elect to treat up to 5 times the annual exclusion amount, so up to $90,000 for 2024, as if you made that contribution evenly over a 5-year period, starting with the year you make the contribution.
So hold on. I could put, say, $90,000 into my grandchild's 529 plan today and elect to treat it as $18,000 per year for the next 5 years, effectively using 5 years of annual exclusions all at once without using my lifetime exemption.
That's exactly right. That's the power of the 5-year spread. It allows you to make a very substantial contribution up front, getting that money invested and potentially going for college sooner, while still maximizing your annual gift tax exclusions over that 5-year period for that specific gift. It accelerates the funding significantly using this specific tax-saving rule. Let's use the IRS example. Donor D puts $100,000 into A's 529 plan in 2024. D elects the 5-year spread for the maximum $90,000. For gift tax purposes in 2024, D reports 2 things for A. First, the $10,000 was over the $90,000 spread amount. That's a gift in 2024. Second, $18,000, which is 1/5 of the $90,000 elected amount, is also treated as a gift in 2024. So the total reported gift for A in 2024 is $28,000, $10,000 plus $18,000. That $18,000 portion is covered by the 2024 annual exclusion. Then for the next 4 years, 2025, 2026, 2027, and 2028, another $18,000 is automatically deemed to be given to A each year from that initial $90,000. That uses up the annual exclusion for A in each of those years for that specific gift without D having to do anything further.
What about filing Form 709 in those later years, 2025 through 2028? Do you have to file just to report that $18,000 deemed gift each year?
Good question. No, generally you don't. If in any of those subsequent 4 years, you don't make any other gifts that would require you to file a Form 709. You don't need to file just because of that year's $18,000 portion of the 529 spread election. You make the election itself on the Form 709 filed for the year you make the large contribution, 2024 in our example. You check a box on Schedule A and attach a statement explaining the details. After that, the allocation over the next 4 years is automatic for annual exclusion purposes. It's a really efficient way for parents, grandparents, whoever, to make a big impact on college savings early on while maximizing those annual exclusions. A very smart tax-saving move.
Okay, the 529 spread is powerful. Now let's tackle something that sounds intimidating. The Generation Skipping Transfer Tax, or GST tax. What is this, and why should listeners care about it? Is there a tax-saving angle here, too?
It does sound intimidating, but yes, understanding it is crucial for significant wealth transfer planning, and yes, there's a major tax-saving component, the GST exemption. The GST tax is basically designed to prevent families from avoiding transfer taxes for multiple generations by skipping over their children and leaving assets directly to grandchildren, or even more remote descendants. It's essentially a second layer of tax on top of any gift or estate tax that applies to certain transfers to skip persons. It most commonly applies to direct skips. These are transfers made during your lifetime that are already subject to gift tax, where the property goes to a skip person.
And who exactly is a skip person? Is it just a grandchild?
A grandchild is the classic example, yes, if their parent, your child, is still alive. Generally, a skip person is any individual who is 2 or more generations younger than the donor, so grandkids, great-grandkids, grandnieces, etc. A trust can also be a skip person if, for example, all the beneficiaries with current interest in the trust are skip persons, or if no distributions can ever be made from the trust to anyone who isn't a skip person. So a trust set up solely for your grandkids would likely be a skip person trust. Transfers to skip persons, whether outright or in trust, can trigger the GST tax.
A second layer of tax sounds painful. How do you save tax here? What's the exemption?
The good news is, every individual has a very generous lifetime GST exemption. For 2024, this amount is the same as the estate and gift tax exclusion, $13,610,000. This exemption is incredibly powerful. You can allocate it to transfers you make, whether during life or at death. When you allocate GST exemption to a transfer, say a gift to a trust for grandkids, it reduces what's called the inclusion ratio of that transfer for GST tax purposes. If you allocate enough exemption to cover the entire value of the transfer, the inclusion ratio becomes 0. And if the inclusion ratio is 0, then that property and all its future growth is effectively exempt from GST tax forever, no matter how many generations it might eventually pass down through. This is the key tax-saving mechanism for multi-generational planning, like creating dynasty trusts.
Okay, $13.6 million is a lot of exemption. How do you allocate it? Is it automatic, or do you have to tell the IRS specifically?
It can be both, which is why understanding the allocation rules is crucial for effective tax saving. For lifetime direct skips, like an outright gift to a grandchild, your unused GST exemption is automatically allocated to cover the transfer, making the inclusion ratio 0 unless you specifically elect not to have it allocated. You typically do that by filing Form 709 and paying the GST tax if you want to save your exemption for other transfers. There are also automatic allocation rules for certain transfers to trust that might have GST potential down the road called indirect skips. Again, the exemption is automatically allocated to make the inclusion ratio 0 unless you elect out. These automatic rules are generally designed to be taxpayer-friendly, ensuring exemption gets used to prevent GST tax. However, you do have control. You can make elections to prevent automatic allocation for specific transfers or specific trusts, perhaps if you want to preserve your exemption for a different, potentially larger future transfer. You can also make affirmative allocations of your exemption.
You can choose to allocate it to transfers that aren't covered by the automatic rules, or even allocate it strategically to a trust that might not have skipped persons now, but could in the future. You typically do this by attaching a notice of allocation to your Form 709. This gives you precise control over this valuable tax-saving asset.
You mentioned something called an estate tax inclusion period, or ETIP, earlier. How does that fit in with GST tax?
Right, an ETIP estate tax inclusion period is relevant here. An ETIP is any period after a transfer during which the value of the transferred property would be included in the donor's gross estate or their spouse's if they were to die. Think of certain trusts where the donor retains an interest, like a grantor retained annuity trust, Grant the Relat, or a qualified personal residence trust, QPRT. For transfers subject to an ETIP, you generally cannot allocate GST exemption to them until the ETIP ends, usually when the donor's retained interest terminates. The GST tax implications are determined, and the exemption is allocated only at the close of the ETIP, based on the property's value at that time. This can be tricky because the property might have appreciated significantly during the ETIP, meaning you'd need to allocate more GST exemption later than if you could have allocated it at the time of the initial gift. It adds a layer of complexity to planning with these types of trusts. And one more related point. There's a special QTIP election for GST purposes. When you make the regular QTP election for marital deduction purposes on a trust for your spouse,
You can also make a separate election, called a reverse QTAC election, to treat yourself, the donor, as the transferor for GST tax purposes, even though the assets will be in your spouse's estate for estate tax purposes. This allows you to allocate your GST exemption to that QTIP trust, typically to make it fully exempt from GST tax for future generations, without having to rely on your spouse's exemption. It offers very precise control over using your GST exemption, another advanced tax saving technique.
Okay, GST is complex, but the exemption is clearly key. One last strategy. Briefly, what about valuation discounts? How can they help reduce gift tax?
Valuation discounts are a legitimate way to potentially reduce the taxable value of certain types of gifted assets, thereby saving tax or staying within exclusion limits. It's complex and often requires professional appraisals. The idea is that a partial interest in certain assets might genuinely be worth less than its simple pro rata share of the whole. Classic examples are gifts of minority interest in a closely held family business, or fractional interest in real estate. Why? Because a minority owner typically lacks control over the business, discount for lack of control, and it's harder to find a buyer for a small, illiquid stake, discount for lack of marketability. Similarly, selling a 25% interest in a vacation home is usually harder and might fetch less per percentage point than selling the whole thing. If these factors genuinely reduce the fair market value an unrelated buyer would pay, you can apply a discount to the value of the gift reported on Form 709. This reduces the amount of annual or lifetime exclusion used, or the tax due. However, big caveat, these discounts are heavily scrutinized by the IRS.
You absolutely need robust, credible appraisals from qualified professionals to support any claim discount. Without strong justification, the IRS is very likely to challenge it, potentially leading to back taxes, interest, and penalties. It's not a DIY strategy.
Okay, lots of powerful strategies there. From the basic annual exclusion and direct payment exclusions to spousal techniques like splitting and portability and advanced tools like 529 spreads, GST exemption allocation, and valuation discounts. Now let's pivot to the practical side, filing the actual form. What are the absolute essentials for getting Form 709 completed correctly?
Right, knowledge is great, but execution matters. Let's talk practicalities and potential pitfalls. First, and this sounds basic but it's critical, completeness. The IRS instructions are very clear. Returns filed without entries in each required field will simply not be processed. Don't leave required lines blank. If something doesn't apply, use NA or 0 as appropriate, but fill it in. Second, the description of the gifts. You need to be incredibly specific. This is key for adequate disclosure. For real estate, full legal description, street address, area. For bonds, quantity, face amount, name of issuer, maturity date, interest rate, exchange listed on, and definitely the CUSIP number. For stocks, number of shares, common or preferred, company name, exchange traded on, CUSIP number. For interest based on someone's life, like an annuity, their date of birth. For closely held businesses, the EIN. For life insurance, the insurer's name and policy number. This level of detail is non-negotiable for a properly filed return.
That is incredibly detailed. And how do you determine the value, especially for things that aren't easily priced like public stock?
Valuation is key. All gifts must be valued at their fair market value, FMV, on the date the gift is made. FMV is defined as the price a willing buyer would pay a willing seller, both having reasonable knowledge of the facts and neither being forced to act. For listed stocks and bonds, it's usually the average of the high and low selling prices on the gift date. If no sales occurred that day, you average prices from the nearest days before and after. For real estate, an appraisal based on comparable sales is often needed, unless there was a very recent arm's-length transaction. And for things like interest in private businesses, unique art, or collectibles, professional appraisals are almost always necessary. You can't just guess.
Which leads to supporting documentation, right? What do you need to attach?
Exactly. You need to back up your numbers. If you make an initial transfer into a trust, you must attach a certified or verified copy of the trust document itself. For gifts of real estate or other hard-to-value property like art or private company stock, you should attach copies of the qualified appraisals you obtained. If you don't attach documentation like an appraisal, the instructions say you must include a detailed explanation on the return itself explaining exactly how you arrived at the reported value. Providing the documentation is always the better, safer route.
Okay. Now, the IRS is clearly trying to keep up with technology. What's this new question about digital assets on the 2024 form? What should listeners know?
Yes, this is a significant update reflecting the times. There's a new question right on page 1 of the 2024 Form 709 asking whether you made any transfers involving digital assets. This includes things like cryptocurrency, Bitcoin, Ether, etc., stablecoins, and non-fungible tokens, NFTs. The really important thing here, this question must be answered yes or no by everyone filing Form 709, not just those who actually gifted digital assets. You cannot leave blank. It shows the IRS is actively tracking these types of assets and wants to ensure they're being properly reported and valued for gift tax purposes, just like any other property. So if you gifted crypto or an NFT, check yes and be prepared to document its fair market value on the date of the gift, which can sometimes be tricky itself.
Good heads up on digital assets. What if someone files and then realizes they made a mistake or forgot something? Can they fix it?
Yes, you can amend a return. If you need to make corrections or add supplemental information, you simply file another Form 709 for the same year. You check the amended return box at the top, include a written statement explaining exactly what changed from the original return and why, and it's usually a good idea to attach a copy of the original Form 709 you filed.
And quickly, logistics for payment if tax is due.
Sure. Make checks or money orders payable to United States Treasury. Always write the donor's Social Security number and the tax year, 2024 Form 709, for example, on the payment. And that quirky rule for huge payments, the IRS physically cannot process a single check for $100 million or more. If you owe that much, lucky you, you need to send multiple checks, each under $100 million. Or more practically, use electronic payment methods which don't have this limit.
Okay. And one last practical point. Authorizing your tax preparer to talk to the IRS about the return.
Right, there's a checkbox near the signature line, the third-party designee section. If you check yes and fill in your preparer's information, you're giving the IRS permission to call your preparer directly, to ask questions about how the return was prepared, get missing information, check on processing status, or respond to certain basic notices. It can definitely streamline communication for minor issues, but it's important to know this authorization is limited. It doesn't let the preparer represent you in an audit, receive refunds, or agree to tax liabilities on your behalf. It's just for clarifying questions about the return itself, and it automatically expires after 3 years. A full power of attorney, Form 2848, is needed for broader representation.
Got it. This form, Form 709, it's clearly complex, but it really lays out the rules of the road for gifting. Understanding it seems essential for smart wealth planning and, crucially, for saving on taxes. We've really covered a lot today in this deep dive into Form 709. We unraveled the basics of gift tax, who files and when, but most importantly, we focused intensely on those powerful tax-saving strategies the system itself provides. We hit the big ones. That crucial $18,000 annual exclusion per person per year. Those fantastic direct payment exclusions for tuition and medical expenses, remember, pay directly and they're not even gifts. We looked at how married couples can amplify their giving through gift splitting to get up to $36,000 per person tax-free each year. And the importance of portability for capturing a deceased spouse's unused exclusion, a huge potential benefit. Plus the restored exclusion amount correcting past inequalities. We touched on the marital deduction, including QTIP trust for specific planning goals. And we explored strategic gifting with 529 plans using that 5-year spread election, the complexities of the GST tax, but the power of its $13.6 million exemption, and even the idea of valuation discounts with proper support.
Absolutely. And understanding these mechanisms, these tax-saving methods, it really isn't just about dodging taxes. It's about exercising control. It's about directing your financial legacy and supporting your loved ones in the most effective way, all within the legal framework. It really pushes you to think critically about how you build, preserve, and transfer wealth, making sure your intentions are actually realized and your assets go where you want them, without unnecessary taxes taking a bite. It's about proactive, informed planning that matches your wealth to your values and goals.
So the final thought for you, our listener, is, what does all this mean for your situation? Maybe it's time to look at your own gifting strategies, or lack thereof, through the lens of these powerful tools we discussed. Could direct payments for education or medical bills save you significant tax? Could gift splitting double your family's tax-free gifting capacity? Is your estate plan set up to capture portability if needed? The tax code, in this area at least, provides a clear roadmap for intelligent, tax-efficient wealth transfer. Until next time, keep learning, keep questioning, and keep making those informed decisions.